There is a paradox that sits at the very heart of modern finance. It's the kind of quiet, uncomfortable truth that once seen can never be unseen. It involves the single greatest investor of all time, a man whose name is synonymous with the art of picking stocks, a financial titan who built a $250 billion empire, brick by brick, by finding undervalued companies and making concentrated, high-stakes bets on them. That man, of course, is Warren Buffett. And the paradox is this. After a lifetime spent mastering the complex, intricate game of beating the market, his primary advice for virtually every single person watching this, for his own family, for his friends, for 99% of the population, is to not play the game at all. Think about that for a second. The grandmaster of a generation, the Michael Jordan of investing, has looked at the court, analyzed the players, studied the statistics for over 70 years, and has come to the stark conclusion that for the overwhelming majority of people, the winning move is not to shoot. The winning move is to buy a ticket to the whole league and simply own a piece of every team's success. This isn't a casual remark or an off-the-cuff comment. It is a deep, foundational principle he has repeated for decades, a piece of advice memorialized in his will, and a truth he was so convinced of that he once wagered $1 million of his own money to prove it, publicly, over the course of a decade. This is the final promise of the world's greatest stock picker, that the path to financial freedom for most is not found in the frantic search for the next Amazon or the next Apple. It is not found in complex algorithms, expensive newsletters, or the confident proclamations of Wall Street gurus. It is found in a strategy of radical simplicity. It is found in embracing a form of intelligent passivity. It is found in one of the most boring, unsexy, and yet profoundly powerful financial instruments ever created, the low-cost S&P 500 index fund. What we are about to embark on is not just a discussion of a particular investment vehicle. It is a fundamental rewiring of your entire approach to wealth creation. We are going to dismantle the myth that complexity equals sophistication. We will expose the hidden costs and psychological traps that cause the average retail investor to consistently underperform, turning their dreams of portfolio growth into a reality of frustrating stagnation. And most importantly, we will build, from the ground up, a new mental framework. A framework that provides a simple, powerful default strategy for building wealth, and one that serves as the crucial benchmark, the unwavering North Star, that any of your own stock-picking efforts must consistently and decisively beat to even be considered worthwhile. This is not just about how to invest. It's about understanding the deep structure of the game itself, so you can finally choose to play it on your own terms. This is the foundation. Chapter 1: The Oracle's Surrender. Our story begins not in a frenetic trading room or a high-powered boardroom, but with a simple public challenge laid down in Warren Buffett's 2005 annual letter to the shareholders of Berkshire Hathaway. For years, Buffett had been observing a trend that deeply troubled him. He saw a burgeoning industry of financial advisors, hedge funds, and private equity firms, charging astronomical fees to wealthy individuals and institutions, all under the promise of delivering superior, market-beating returns. They were the so-called helpers, the financial elite, who positioned themselves as indispensable navigators of market complexity. Yet Buffett, with his unparalleled view of the financial world, knew that for the most part, their promises were hollow. He knew that the immense friction of their fees, combined with the inherent difficulty of outperforming, meant that their clients were often worse off than if they had done nothing at all. So he issued a challenge. He wrote that a long-term investment in a portfolio of these high-fee helpers would, after costs, underperform a simple, unmanaged, low-cost S&P 500 index fund. For 2 years there were no takers. The financial world, it seemed, was happy to sell their services but unwilling to publicly bet on their own performance. Then, in 2007, a firm called Protégé Partners LLC stepped into the ring. Ted Seides, a co-manager of the firm, accepted the wager. The stakes were set at $1 million, with the winnings going to a charity of the victor's choice. The battleground was a 10-year period, from January 1, 2008 to December 31, 2017. The terms were a perfect encapsulation of the debate. Protege partners would not pick a single hedge fund, but a fund of funds. In fact, they would select 5 different funds of funds, which in turn would collectively hold positions in over 200 individual hedge funds. This was their A-team, the best of the best, a diversified portfolio of the smartest minds in finance, all working diligently to generate what is known in the industry as alpha, or returns above the market benchmark. On the other side of the ledger was Buffett's champion, a single, boring Vanguard S&P 500 Admiral Shares Index Fund. It was the epitome of passive investing. No genius managers, no complex algorithms, no high-frequency trading. Just a simple vehicle designed to do one thing: mimic the performance of the 500 largest publicly traded companies in America for a minuscule fee. It was the ultimate showdown, the supposed best of Wall Street versus the simple power of the American economy, the sophisticated versus the simple, the active versus the passive. The ink was barely dry on the agreement when the world changed. The starting pistol for the bet fired on January 1, 2008, just as the global financial crisis was beginning to uncoil. The stock market was about to enter one of the most terrifying periods in modern history. In that first year, the market plunged. The S&P 500 Index Fund, Buffett's chosen vehicle, was savaged, losing a staggering 37% of its value. The hedge funds, with their ability to short the market and employ sophisticated hedging strategies, did much better. They were down, but only by about 24%. In the first inning of this 10-year game, the expensive helpers were proving their worth. They were protecting capital in a downturn just as they promised. The financial press took note. It seemed Buffett's simple approach was dangerously naive in a volatile world. But Buffett, a man who famously advises investors to be greedy when others are fearful, was unfazed. He understood that a single year, even a catastrophic one, is just noise in the grand scheme of long-term investing. The true test was not who could lose the least in a crash, but who could compound wealth most effectively over a full market cycle. And as the years ticked by, a relentless, almost boring trend began to emerge. The market recovered. From the ashes of 2008 and 2009, American business began its long, steady climb back. The S&P 500, representing the collective engine of the American economy, chugged along. It had good years and mediocre years, but the upward trend was unmistakable. Meanwhile, the supposedly brilliant minds at the 200 hedge funds were facing a much tougher battle. They weren't just fighting the market, they were fighting their own fee structures. A typical hedge fund in that era operated on a, quote, 2 and 20 inches model. That meant they charged a 2% management fee on all assets, every single year, regardless of performance. And on top of that, they took 20% of any profits they generated. But remember, protege partners had selected 5 knife funds of funds. These entities added their own layer of fees, typically another 1% management fee and 5% of the profits, for the service of picking the underlying hedge funds. This created a cascade of costs, a brutal, wealth-eroding friction that acted like a parachute on their returns. Before their investors could see a single dollar of profit, the managers had to clear these incredibly high hurdles, year after year. By the midpoint of the bet, around 2012, the S&P 500 had pulled ahead. By 2015, it wasn't even a contest. The gap had become a chasm. The hedge funds, with all their supposed brilliance and tactical maneuvering, were being left in the dust. Ted Seides of Protege Partners would later write about the experience, admitting the psychological weight of watching the slow, inevitable defeat. Each year the numbers would come in, and each year the simple, cheap index fund would stretch its lead. There were no dramatic blow-ups. It was a quiet, mathematical strangulation. In May of 2017, with more than half a year still left to go, Ted Seides conceded defeat in a column for Bloomberg. He threw in the towel. The final numbers were devastatingly one-sided. Over the 10-year period, the S&P 500 index fund that Buffett selected had an average annual return of 7.1%. The portfolio of elite hedge funds, after their colossal fees were taken out, returned an average of only 2.2% per year. To put that in perspective, a $1 million investment in Buffett's simple index fund would have grown to over $1.98 million. The same $1 million entrusted to the smart money would have grown to just over $1.24 million. The difference was more than $750,000. The simple, passive approach didn't just win, it annihilated the competition. The $1 million prize went to Girls Inc. of Omaha, but the true value of the bet was the lesson it broadcast to the world, a lesson that cuts to the very core of our relationship with money and expertise. The psychological principle at play here is one of the most potent in human cognition: authority bias. We are hardwired to defer to the judgment of experts. When a doctor in a white coat gives us medical advice, we take it. When a seasoned pilot is in the cockpit, we relax. And when a financial manager in an expensive suit, armed with complex charts and impenetrable jargon, recommends a sophisticated investment strategy, our instinct is to trust them. They project confidence, they possess specialized knowledge, and they operate in a world that seems impossibly complex to an outsider. This deference to authority saves us time and cognitive energy in most areas of life. But in the world of investing, it can be a catastrophic vulnerability. The entire active wealth management industry is built upon the foundation of authority bias. They cultivate an aura of indispensability. They create products with names designed to sound intelligent and exclusive. They use performance data selectively, highlighting periods of outperformance while quietly burying the long-term reality. Buffett's $1 million bet was a masterful piece of psychological jujitsu. He used his own immense authority, his status as the, quote, oracle of Omaha, to attack the very concept of relying on financial oracles. He was, in effect, saying, quote, I am the expert you all listen to, and I am telling you that for most of you the entire industry of experts is not worth the price of admission. It forces a cognitive dissonance that is impossible to ignore. If the ultimate authority on picking stocks tells you not to hire people to pick stocks, you are forced to question the fundamental premise of the entire industry. For Ted Seedy's and protege partners, their decision to take the bet was likely driven by their own form of this bias, coupled with a healthy dose of professional overconfidence. They were authorities in their own world, surrounded by other highly intelligent, highly paid individuals who all believed they possessed a special edge. They were inside the echo chamber, and Buffett's challenge was an affront to their professional identity. They had to defend their craft. But the bet cruelly exposed that their perceived authority was no match for the simple, relentless arithmetic of costs and market returns. This story gives us a powerful applied mental model which we can call the Oracle's test. It's a simple blueprint for evaluating any financial product or advisor that promises to beat the market. Before you invest a single dollar based on someone else's expertise, you must apply this test. The first question is, what is the total, all-in, annual cost of this strategy? This includes management fees, performance fees, advisor fees, trading costs, and any other hidden expenses. The second question is, can you show me independently verifiable data that this exact strategy has outperformed a low-cost S&P 500 index fund over the last 10 years, after all of those fees have been deducted? This simple two-question model acts as an incredibly effective filter. It cuts through the sales pitch, the jargon, and the appeal to authority. You will find that the vast majority of products and advisors simply cannot pass this test. They will offer excuses. They'll say past performance is not indicative of future results, which is true, but it's the only evidence we have. They'll point to a recent hot streak of a year or two. They'll argue their strategy is different and provides downside protection. But the Oracle's test is ruthless. A decade is long enough to cover a full market cycle. If they couldn't beat a simple, cheap alternative over 10 years, what logical reason is there to believe they will do so over the next 10? By applying this mental model, you shift the burden of proof from you to them. You are no longer a passive recipient of their authority. You are a skeptical auditor of their claims. The default position becomes the index fund, and any deviation from it must clear an incredibly high evidentiary bar. The antithesis to this disciplined approach is what we can call the path of the guru chaser. This is the path taken by the 99% of investors who lose the game. The guru chaser is perpetually on a quest for a shortcut, for the secret knowledge that will unlock market riches. They are addicted to the promise of alpha. Their journey often begins with a talking head on a financial news network, a charismatic figure who confidently predicts the next big market move. The guru chaser listens, buys the recommended stock, and for a short time, they might even be right. The initial success provides a powerful dopamine hit, reinforcing the belief that they've found a true oracle. But then, inevitably, the guru is wrong. The hot stock cools, the can't-miss prediction misses, and the portfolio takes a hit. The guru chaser, disillusioned, doesn't question the game itself, only the player. They discard the old guru and begin the search for a new one. Perhaps this time it's a popular YouTuber with a complex technical analysis system. Or maybe it's a subscription newsletter promising to identify the next Tesla. They jump from guru to guru, from strategy to strategy, always chasing the fleeting high of a winning pick. They are prey to authority bias in its most virulent form, mistaking confidence for competence and a good story for a sound investment. Their portfolio becomes a chaotic graveyard of past gurus, recommendations, a collection of assets bought at the peak of hype and sold in the trough of despair. They never stop to perform the oracle's test because they are emotionally invested in the idea that a secret exists. The ultimate tragedy of the guru chaser is that they spend a fortune in fees, trading costs, and most importantly, lost opportunity, all in the pursuit of a goal that the greatest investor in history has shown is, for them, a statistical mirage. The direct financial connection of this principle is stark and undeniable, as illustrated by the bet itself. Let's make it personal. Imagine on January 1, 2008, you were planning for your retirement and had $100,000 to invest. You have two choices for your wealth management. Option A is the guru chaser's path. You find a polished wealth advisor who recommends a portfolio of actively managed funds and hedge funds, promising sophisticated strategies and downside protection. Your all-in cost is roughly 2.5% per year. Option B is Buffett's path, a simple, low-cost S&P 500 index fund with an annual cost of 0.04%. At the end of the 10-year period, on December 31, 2017, we look at your account statements. The person who chose option B, the simple S&P 500 fund, would have seen their $100,000 grow to roughly $198,000 based on the actual returns from that period. They did nothing but buy and hold. They weathered the 2008 storm and simply trusted in the long-term growth of the American economy. The person who chose option A, the path of the expensive helpers, would have seen their $100,000 grow to only about $124,000. That's a difference of $74,000. That is not a small number. That is a car. That is a college fund. That is years of financial freedom. That $74,000 didn't just vanish, it was transferred. It was transferred from your retirement account to the pockets of the fund managers, the advisors, and the Wall Street machine, all in the name of an expertise that failed to deliver. This is not a hypothetical. It is the direct, quantifiable result of the very public experiment Buffett conducted. The bet wasn't just a philosophical statement. It was a financial ledger showing the massive, tangible cost of ignoring the simple truth in favor of the seductive promise of sophistication. It demonstrates that the single most important decision in your asset allocation journey might not be which stocks you pick, but how much you are willing to pay for the illusion of an edge. Chapter 2: The Tyranny of Fees. If Warren Buffett's million-dollar bet represents the public, dramatic proof of the index fund's superiority, then the life's work of another financial giant, Jack Bogle, represents its philosophical and mathematical soul. You cannot understand the profound power of this simple investing strategy without understanding the story of the man who is considered its father. Bogle's journey was not one of celebrated genius from the start. It was a crusade. a lonely and often ridiculed battle against the entire entrenched financial establishment. His story is the key to unlocking the second and perhaps most critical pillar of our thesis: the silent, devastating, and relentless tyranny of fees. Jack Bogle's career began conventionally enough. He rose through the ranks at the esteemed Wellington Management Company, a classic active investment firm. He was a true believer in the power of diligent research and expert stock selection to beat the market. In the late 1960s, at the helm of the company, he steered it into the go-go era of the stock market, embracing the aggressive, performance-chasing ethos of the time. But this strategy, which worked so well in a rising market, proved catastrophic when the tide turned. A poorly timed merger and the brutal bear market of 1973-74 brought the firm to its knees, and Bogle was fired from the job he loved. He would later call this devastating professional failure the single most important event of his life. It was in this crucible of failure that his revolutionary idea was forged. Humbled and stripped of his belief in the infallibility of star fund managers, he went back to first principles. His research led him to a simple but profound observation, first articulated by the economist Paul Samuelson: for the market as a whole, the collective return of all investors must equal the return of the market itself. However, because investors as a group have to pay costs, management fees, brokerage commissions, trading spreads, their average return after costs must, by an unbreakable law of arithmetic, be worse than the market's return. Therefore, a strategy that simply bought and held all the stocks in the market and minimized costs would mathematically have to outperform the average active investor. This was heresy. The entire business model of Wall Street was predicated on the idea that they could provide value that justified their fees. Bogle was proposing a model that essentially called the entire industry a giant tax on investor returns. In 1975, using the corporate shell of the company that had fired him, he founded a new kind of investment firm, one structured as a mutual company, owned by its own funds, and therefore by its shareholders. He called it the Vanguard Group, and in 1976 he launched its flagship product, the first index investment trust, later renamed the Vanguard 500 Index Fund. It was the world's first index fund available to the general public. The industry's reaction was not just skeptical, it was openly hostile. It was mocked as Bogle's folly. A poster circulated by a competitor showed Uncle Sam pointing a finger with the caption, "Index funds are un-American," arguing that they represented a cowardly refusal to bet on the success of individual American companies. Fidelity's chairman at the time famously said he couldn't believe the great masses of investors are going to be satisfied with receiving just average returns. The fund's initial public offering was a spectacular failure, raising only $11 million, a fraction of its $150 million target. For years, Bogle and Vanguard were outcasts, lonely prophets of a simple mathematical truth in a world that craved the excitement and promise of high-stakes stock picking. But Bogle was relentless. He wrote books, gave speeches, and tirelessly proselytized the gospel of low-cost investing. He wasn't just selling a product. He was fighting for a new philosophy of wealth management, one based on common sense, arithmetic, and a deep respect for the power of compounding. Slowly, painstakingly, the idea began to take hold. The numbers were too powerful to ignore. As decades of data accumulated, it became increasingly clear that Bogle's folly was, in fact, Bogle's triumph. He had engineered a revolution, one that would save investors not millions, but trillions of dollars over the coming decades, and in doing so, he cemented the foundational argument for passive investing. The core psychological principle that makes the fee-based active management industry so successful and so dangerous is our brain's profound inability to intuitively grasp the power of compounding, especially when applied to costs. This is often called the power of insignificant numbers. When an advisor tells you their management fee is only 2%, your brain processes that as a tiny, almost negligible amount. 2 pennies on the dollar. What's the big deal? It seems like a small price to pay for professional expertise. Our minds are not built for exponential thinking. We think in linear terms. We can easily imagine what it means to walk 2 miles versus 1 mile. We cannot easily imagine the difference between a penny that doubles every day for a month and $1 million. This cognitive blind spot is what Jack Bogle fought against his entire life. The 2% fee isn't just 2 cents on the dollar times this year's cents. It is a 2% drag on your entire nest egg, year after year, decade after decade. And crucially, it's not just a 2% reduction in your principal. It is a 2% reduction in the asterisk returns that your principal could have generated. It's a silent parasite that feeds not just on your money, but on your money's future potential. Over a 40-year retirement planning horizon, this seemingly insignificant number compounds into a monstrous sum, a hidden tax that can devour more than half of your potential wealth. The financial industry understands this psychological loophole perfectly. They frame fees as small, manageable numbers, knowing full well that our brains will fail to calculate their true devastating long-term impact. Bogle's great insight was to recognize that flipping this equation, minimizing cost to an equally insignificant number like 0.04%, would create a positive compounding effect of almost unimaginable power, allowing investors to keep the lion's share of the market's return for themselves. This leads us to an intensely practical mental model for every retail investor, the fee X-ray blueprint. You cannot fight an enemy you cannot see. The purpose of this blueprint is to make the invisible, corrosive power of fees visible and tangible. It's a diagnostic tool for your own portfolio. The first step is to become a financial detective. Go through every single investment you own, your 401k, your IRA, your brokerage account. For each mutual fund, or ETF, you must find its expense ratio. This number is usually buried in the fund's prospectus or can be found with a quick search on financial websites like Morningstar or Yahoo Finance. Write it down. The second step is to identify any additional layers of fees. Do you have a financial advisor who charges a percentage of your assets under management? Add that number. Are you paying trading commissions, account maintenance fees, or hidden 12b1 marketing fees? Add those up. You need to arrive at a single, all-in annual cost for your portfolio. The third and most crucial step is to project the long-term impact. Go to any online investment calculator. Input your current portfolio value, your estimated annual contributions, and your expected investment timeline, say 30 years. Run the calculation using an average market return, like 8%. Now run the exact same calculation, but this time subtract your all-in fee percentage from the annual return. For example, if you expect an 8% return and your fees are 2%, run the projection at a 6% return. Finally, run the projection a third time using the expense ratio of a low-cost S&P 500 index fund, which might be as low as 0.04%. So you'd run the calculation with a 7.96% return. The difference between the final values of these projections will be the single most illuminating financial calculation you ever perform. It will translate the abstract percentage into a concrete number, the dollar amount you are set to lose over your lifetime. This fee X-ray transforms you from a passive consumer of financial products into an informed auditor. It forces you to confront the true price of help and provides the analytical foundation for making rational decisions about your financial future. The antithesis of this forensic, cost-conscious approach is the sophisticated investor trap. This is the path walked by those who conflate price with quality, a common heuristic that serves us well when buying a watch or a car, but which is often inverted in the world of finance. The sophisticated investor is seduced by exclusivity. They are drawn to investments that are complex, hard to access, and, most importantly, expensive. They believe that a high-fee hedge fund or a private equity deal must be superior, precisely because it is expensive and exclusive. They are paying for the story, for the feeling of being an insider. Investment advisors who cater to this mindset are masters of narrative. They don't sell performance, they sell prestige. They talk about proprietary strategies, alternative investments, and institutional-grade opportunities. They create a sense of belonging to an elite club that has access to secrets the average retail investor doesn't. This investor is not buying a financial return, they are buying a status symbol. They would be embarrassed to tell their friends at the country club that their wealth management strategy is simply to buy the same Vanguard index fund that their plumber owns. The irony is brutal. In their quest for sophistication, they fall for the oldest sales trick in the book, convincing the customer that a higher price tag guarantees a better product. They end up paying a premium price for what is, in the vast majority of cases, a chronically underperforming asset, while the plumber who embraced simple investing quietly builds a far larger nest egg. Jack Bogle's revolution was so profound because it was deeply democratic. It declared that the best investment strategy should not be a secret reserved for the wealthy, but a simple, transparent, and low-cost tool available to everyone. Now let's connect this directly to your financial statement. Let's quantify the heist. We will use a standard retirement planning scenario. Imagine two individuals, both 25 years old, who each start with a $10,000 investment and commit to saving $500 per month, $6,000 per year, for the next 40 years until they are 65. We will assume a conservative average annual stock market return of 8%. Investor A chooses the path of simple investing. They put all their money into a low-cost S&P 500 index fund with an expense ratio of 0.04%. Their effective annual return is 7.96%. After 40 years of disciplined, automated contributions, their portfolio will have grown to approximately $1.99 million. They will have achieved a remarkable level of financial freedom through consistency and a ruthless focus on minimizing costs. Investor B chooses the path of the sophisticated investor. They are persuaded by an advisor to invest in a portfolio of actively managed funds that carry an average all-in cost of 2% per year. Their effective annual return is 6%. After the same 40 years of making the exact same contributions, their portfolio will have grown to approximately $1.09 million. Take a moment to absorb those numbers, a difference of nearly $900,000. That is the cost of a 2% fee. That is the tyranny of fees made manifest. It is a life-changing amount of money. It is the difference between a comfortable retirement and a lavish one. It is the difference between working until 70 and having the option to stop at 55. And where did that $900,000 go? It didn't disappear. It was skimmed off, year after year, in small, insignificant amounts, to pay for the salaries, marketing budgets, and office buildings of the active management industry. This is the direct financial consequence. Over a lifetime, a seemingly small fee is not a small leak. It is a gaping hole in the hull of your financial ship. Jack Bogle's gift to the world was a simple, elegant patch for that hole, allowing you to keep the full power of the market's compounding engine working for you, not for Wall Street. Chapter 3: The Haystack Instead of the Needle. Once we accept the devastating impact of fees and the statistical futility of hiring expensive managers, the next logical question arises: why the S&P 500 specifically? Why bet on this particular basket of 500 companies? The answer lies in one of the most powerful concepts in finance, a principle that guards against both catastrophic loss and the hubris of prediction: diversification. The core idea is to shift your goal from finding the single sharpest needle in the haystack to simply buying the entire haystack. To understand why this is so critical, we need to travel back to a time when the opposite philosophy reigned supreme, a period that serves as a powerful cautionary tale about the dangers of concentrated bets, even in what appeared to be the best companies in the world. Welcome to the early 1970s, the era of the Nifty 50. This was a group of about 50 large-cap stocks that were widely regarded as one-decision investments. You bought them, and you held them forever. They were the blue-chip champions of the American economy, companies like Xerox, IBM, Polaroid, Coca-Cola, and McDonald's. They had consistent earnings growth, dominant market positions, and what seemed like unassailable competitive advantages. Wall Street analysts and institutional investors fell in love with them. The prevailing wisdom was that their quality was so high that the price you paid for their stock was almost irrelevant. You could buy them at any valuation because their inevitable, endless growth would eventually justify it. This created a feedback loop, a classic market bubble. As more and more money poured into these 50 chosen stocks, their prices soared to astronomical levels, with price-to-earnings ratios exceeding 50, 60, or even 100. They became the darlings of the market, the ultimate needles in the haystack that every serious investor had to own. Portfolios became dangerously concentrated in these names. Why would you diversify when you could own these guaranteed winners? It seemed like a foolproof path to portfolio growth. Then came the brutal bear market of 1973-1974. A combination of the OPEC oil embargo, stagflation, and political uncertainty sent the entire market reeling. But the Nifty 50, the supposedly invincible stocks, were hit the hardest. Their stratospheric valuations, which had been built on a foundation of pure optimism, came crashing back down to earth. Xerox fell by nearly 71%. Polaroid, a technology superstar of its day, plummeted by a staggering 91%. Avon dropped 86%. Even the mighty IBM lost half its value. The one-decision stocks became a portfolio-destroying nightmare. Investors who had concentrated their life savings in these can't-miss companies were financially and emotionally obliterated. The lesson was brutal and clear: no company is invincible. And the belief that you can identify a small handful of guaranteed long-term winners in advance is a form of financial hubris that the market will eventually and cruelly punish. The Nifty 50 crash taught a generation of investors that the search for the needle is fraught with hidden, catastrophic risk. The psychological trap that created the Nifty 50 bubble and that continues to lure investors into making concentrated bets today is a powerful combination of the availability heuristic and survivorship bias. The availability heuristic is our mental shortcut of judging the likelihood of an event by how easily examples come to mind. When we think about successful investing, the stories that leap into our consciousness are the spectacular winners. We hear about the person who bought Apple in 2002, or Amazon in 1998, or Tesla in 2012. These stories are dramatic, they are repeated endlessly in the media, and they create a vivid, memorable picture of how immense wealth is created through savvy stock picking. This is amplified by survivorship bias. We only see the winners. The thousands upon thousands of companies that were once promising but ultimately failed, went bankrupt, or were acquired for pennies on the dollar simply disappear from the narrative. There are no news articles celebrating the 20th anniversary of Pets.com's bankruptcy or the spectacular failure of Webvan. The financial graveyard is silent. This skewed information diet leads our brains to a deeply flawed conclusion: that picking big winners is a common and achievable outcome. We vastly overestimate our chances of success because the evidence we see is a curated highlight reel of the tiny fraction of companies that survived and thrived. The S&P 500 index fund is the perfect antidote to these cognitive biases. It does not rely on memorable stories or hyped-up narratives. It is a systematic, emotionless strategy that embraces the full, unvarnished reality of the market. By buying the index, you are not trying to predict the future. You are simply acknowledging that you cannot. Instead of trying to guess which of today's small companies will become the giants of tomorrow, you guarantee that you will own them when they do. As companies grow and become more valuable, their weighting in the index automatically increases. As companies falter and shrink, their weighting decreases, and eventually they are removed from the index altogether. The S&P 500 automatically and systematically gets rid of its losers and rides its winners. It captures the brutal, creative destruction of capitalism without forcing you to make a single prediction. It sidesteps the availability heuristic and survivorship bias by owning both the eventual survivors and the legions of companies that will inevitably fall by the wayside. This leads us to a liberating applied mental model, the automatic winner framework. This is a fundamental shift in perspective for any aspiring investor. The first step is to internalize the data. A tiny fraction of stocks are responsible for the vast majority of the market's long-term gains. Your job is not to find these companies in advance. That is a task of near impossible difficulty, akin to finding a specific grain of sand on a vast beach. The second step is to change your goal. Your goal is not to find to the winners. Your goal is to own the winners. The third step is to embrace the mechanism. By purchasing a low-cost S&P 500 index fund, you are hiring the market itself to do the work for you. You are guaranteed to own the next Microsoft, the next Google, the next NVIDIA. You will own them in proportion to their success, and you don't have to lift a finger to find them. They will find their way into your portfolio automatically through the mechanics of the index. This framework transforms investing from a stressful, high-stakes treasure hunt into a calm, disciplined process of ownership. It removes the ego and the pressure to be a genius stock picker. Your success is no longer dependent on your ability to outsmart millions of other intelligent market participants. Your success is tethered to the long-term ingenuity, productivity, and growth of the American economy as a whole. It is a profound act of intellectual humility that paradoxically leads to a superior financial outcome. This is the very essence of passive investing. The antithesis of this approach is the concentrated genius gambler. This is the retail investor who, convinced by survivorship bias and a compelling story, places a massive portion of their net worth into a handful of stocks, or sometimes even a single stock. They are not investing. They are making a high-stakes bet on a particular narrative. Perhaps it's a revolutionary biotech company promising to cure a major disease. Perhaps it's a charismatic CEO with a vision for changing the world. The concentrated genius feels a deep, personal connection to these companies. They are not just investments, they are part of their identity. They spend hours on Reddit forums, they watch every interview with the CEO, and they evangelize the stock to their friends and family. When the stock goes up, they feel like a visionary, a genius who saw the future before anyone else. But their entire financial well-being is balanced on a knife's edge. A single piece of bad news, a failed clinical trial, a new competitor, a regulatory change, can send their chosen stock plummeting, wiping out a huge percentage of their wealth in a matter of days. Because they are so emotionally invested, they are unable to react rationally. They refuse to sell, convinced it's just a temporary setback, a classic case of loss aversion. They may even double down, throwing good money after bad, until their dream of a 100x return becomes the nightmare of a 99% loss. The path of the concentrated genius is littered with financial ruin. They have mistaken a lottery ticket for an investment strategy, and they almost always end up paying the price for that confusion. The direct financial connection here can be found in the academic research on the skewness of stock market returns. Professor Hendrik Bessembinder of Arizona State University conducted a landmark study looking at the performance of every single common stock listed on U.S. exchanges from 1926 to 2016. The results were staggering. Over their full lifetimes, the majority of stocks, more than 50%, actually delivered a negative return. The vast majority of stocks, over 96%, failed to outperform simple, risk-free one-month Treasury bills. So where did the market's overall positive return come from? It came from a tiny sliver of superstar companies. Just 4% of all listed stocks accounted for 100% of the net wealth creation of the entire U.S. stock market over that 90-year period. Let that sink in. Your odds of picking a stock at random and having it be one of the long-term wealth-creating powerhouses are just 1 in 25. The other 24 times, you would have been better off just holding cash in a savings account. This is the brutal math that the concentrated genius is up against. They are trying to find the 4% while ignoring the 96%. An S&P 500 index fund solves this problem elegantly. By buying the entire market, you guarantee that your portfolio is exposed to the positive skew of these massive winners. You get all of the upside from that top 4%, which more than compensates for the mediocre performance of the other 96%. It is the only strategy that ensures you capture the market's full return, a return that is mathematically driven by a very small number of extraordinary companies. This principle of diversification is not just about avoiding losses. It's about guaranteeing that you participate in the massive, asymmetric gains that are the true engine of stock market wealth creation. Chapter 4. The Ego is the Enemy. We have now established the mathematical case for passive index fund investing, grounded in the twin pillars of low costs and broad diversification. But there is a third, equally powerful force that makes this strategy so effective. It acts as a bulwark against our own worst enemy, the single greatest threat to our long-term portfolio growth. That enemy is not Wall Street, it is not market crashes, and it is not a bad economy. The enemy is us. It is the collection of deeply ingrained cognitive biases, emotional reactions, and self-destructive behaviors that lead the average investor to consistently sabotage their own success. To truly understand this, we must journey into the heart of a market mania and witness how human psychology can transform rational individuals into a speculative mob. Let us rewind the clock to the late 1990s, to the height of the dot-com bubble. For a few brief, shining years, it felt as though the old rules of finance had been repealed. A new paradigm had arrived, powered by the promise of the internet. Companies with no profits, no revenues, and sometimes not even a coherent business plan were going public and seeing their stock prices multiply overnight. Cab drivers were trading tech stocks between fares. Dentists were quitting their practices to become day traders. It was a time of boundless optimism, and for anyone participating, it felt less like investing and more like a national gold rush. Let's imagine a hypothetical retail investor from that era. Let's call him Dave. Dave is a smart guy, an engineer, logical and analytical in his professional life. He hears the stories from his friends and colleagues about the easy money being made. Hesitantly at first, he dips his toe in, buying a small stake in a popular company like Pets.com. The stock doubles in a month. Dave is ecstatic. He feels a rush of adrenaline, a sense of intellectual superiority. He didn't just get lucky, he was smart enough to see the future. He starts spending his evenings and weekends researching other dot-com stocks, devouring articles in tech magazines, and soaking up the bullish commentary on financial television. He sells his old economy mutual funds and goes all in on tech. His portfolio soars. He feels like a genius. He starts giving stock tips to his family at Thanksgiving. He even considers leaving his engineering job, which now seems so slow and tedious compared to the fast-paced thrill of the market. Dave, like millions of others, was no longer investing based on fundamentals like price and earnings. He was investing based on narrative, momentum, and the intoxicating feeling of being right. He was caught in the grip of a powerful psychological vortex. Then, in March of 2000, the music stopped. The Nasdaq index, which had been on a meteoric rise, began to falter. At first, Dave dismissed it as a healthy correction, a, quote, buying opportunity. He held on, his belief unshaken. But the slide continued, gathering speed. Panic began to replace greed. Companies he believed in, like Webvan and eToys, started to go bankrupt, their stocks becoming worthless. The headlines turned from euphoric to apocalyptic. The feeling of being a genius was replaced by a gnawing, sickening dread. For 2 long years, the market bled. The Nasdaq would ultimately lose nearly 80% of its value from its peak. Finally, near the absolute bottom in late 2002, Dave couldn't take it anymore. The pain of seeing his life savings evaporate was too much. He sold everything, locking in devastating, life-altering losses. He swore off the stock market forever, convinced it was a rigged casino. Dave's story is not an outlier. It is the textbook emotional journey of the average investor in every market bubble and bust throughout history. He was not a victim of the market. He was a victim of his own predictable, irrational human psychology. The tragic journey of our investor, Dave, was driven by a powerful cocktail of three specific cognitive biases. The first is overconfidence bias. His initial success was likely due to pure luck, but his brain interpreted it as skill. This inflated his ego and led him to believe he was smarter than the collective wisdom of the market. He developed an illusion of control, thinking he could predict the future of these new, unproven companies. This overconfidence caused him to take on far more risk than was prudent, concentrating his entire portfolio in a single, overheated sector. The second bias was herd mentality. As the bubble inflated, Dave was surrounded by social proof. His friends, the news media, the entire culture seemed to confirm that buying .com stocks was the right thing to do. The fear of missing out, or FOMO, became an overwhelming force. It's a primal instinct to want to be part of the herd. In ancient times, being left behind meant death. In financial markets, this instinct is deeply destructive. It pushes us to buy assets not when they are cheap and unloved, but when they are expensive and popular, at the point of maximum financial risk. Finally, when the market turned, the most powerful bias of all took over: loss aversion. Pioneering research by psychologists Daniel Kahneman and Amos Tversky has shown that, for the human brain, the pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain. This is why a $1,000 drop in our portfolio feels so much more intense than a $1,000 gain. As the .com crash accelerated, the psychological pain for Dave became unbearable. This intense aversion to further losses drove him to sell at the worst possible moment, near the bottom of the market. His decision was not logical. It was a purely emotional pain avoidance response. This cycle, overconfidence and hurting on the way up, followed by panic and loss aversion on the way down, is the psychological engine that perpetually separates investors from their money. The solution to this self-sabotage is not to become a robot, but to create a system that insulates your decisions from your emotions. This is the automated discipline blueprint. It is a preemptive strike against your future, irrational self. The first and most important step is to automate your investments. Set up a recurring automatic transfer from your bank account to your low-cost S&P 500 index fund on a specific day of the month or every payday. This is known as dollar cost averaging. By doing this, you are buying consistently, whether the market is up, down, or sideways. You are removing the single most destructive decision an investor can make: when to invest. This system does it for you, without greed or fear. The second step is to write a simple, one-page investment policy statement. This is a contract with yourself. It should state your financial goals, e.g., retirement at age 65, your chosen strategy, e.g., investing in a low-cost S&P 500 index fund, and your commitment to stick with that strategy through thick and thin. The act of writing it down makes it tangible and reinforces your commitment. The third step is to create a panic plan. Before the next market crash happens, and it will happen, you need to decide in advance exactly what you will do. The plan should be brutally simple. For example, during a market decline of 20% or more, I will take the following action. Nothing. I will not sell. I will not check my portfolio every day. I will continue my automated investments as scheduled. Some might even add, if I have extra cash, I will invest more. By pre-committing to a rational course of action during a calm state of mind, you create a behavioral circuit breaker that can save you from making a catastrophic emotional decision in a moment of panic. This automated, pre-committed system is the key to surviving your own worst instincts. The antithesis of this disciplined, automated approach is the market timer and the news junkie. This investor believes they are clever enough to dance in and out of the market. They are glued to the financial news, treating it not as information, but as an instruction manual. When a TV analyst warns of an impending recession, they sell everything and move to cash, proud of their prudent risk management. When the Federal Reserve Chairman makes a dovish statement, they jump back in, trying to catch the next wave up. They operate under the illusion that they can predict short-term market movements based on headlines and economic data. What they fail to realize is that the market is a forward-looking mechanism, and by the time something is a major news story, it is almost always already priced into the assets. Furthermore, their strategy is doomed by a simple mathematical reality: market returns are not distributed evenly. They are concentrated in a very small number of explosive, unpredictable days. Research has consistently shown that if you miss just the 10 best days in the market over a 20-year period, your total returns can be cut in half. Missing the best 20 or 30 days can erase almost all of the gains. Since it is impossible to know when these days will occur, the only rational strategy is to remain invested through all of them. The market timer, in their frantic effort to avoid the bad days, almost invariably misses the best days as well, and their portfolio performance is crippled as a result. They are engaged in a constant, high-stress, and ultimately futile game that a simple buy-and-hold strategy effortlessly wins. The direct financial consequence of these behaviors is captured in a concept known as the behavior gap. For decades, a research firm called Dalbar has published a study called Quantitative Analysis of Investor Behavior. Year after year, it reveals a shocking truth. The average investor in equity mutual funds earns a return that is significantly lower than the return of the very funds they are invested in. For example, over a 20-year period, the S&P 500 might generate an average annual return of, say, 10%. But the average investor holding an S&P 500 fund might only earn 7%. Where did that 3% per year go? It was vaporized by bad behavior. It was lost by pulling money out during panics and pouring it back in after the market had already recovered. It was lost by chasing hot funds at their peak and selling them after they went cold. This 3% difference per year, the behavior gap, is the direct, quantifiable cost of emotional decision-making. Over a lifetime of investing, this gap can amount to hundreds of thousands or even millions of dollars in lost wealth. The simple, automated strategy of investing in a low-cost S&P 500 index fund and then doing nothing is so powerful because its primary function is to close this gap. It forces you to capture the market's actual return rather than the much lower investor return that most people experience. It is a system designed to protect you from yourself, and the financial benefit of that protection is immeasurable, forming the bedrock of any successful long-term retirement planning. Chapter 5: The Benchmark and the Bar. We have now arrived at the final, transformative pillar of this philosophy. We understand the math of fees, the logic of diversification, and the psychology of self-sabotage. But the true power of the S&P 500 index fund is not just as a passive investment. It is as an active mental tool. It is the ultimate benchmark, the unwavering bar against which all other financial decisions must be measured. Embracing this concept fundamentally changes the questions you ask about your money. It shifts the focus from a frantic search for success to a rigorous definition of it. This final step is what elevates a simple investing tactic into a comprehensive wealth management framework, especially for entrepreneurs, executives, and anyone who wants to be truly intelligent about the allocation of their two most precious resources, their capital and their time. To illustrate this, let's tell the story of a different kind of investor. Let's call her Sarah. Sarah is not a naive retail investor. She's a successful entrepreneur. She built a thriving marketing agency from the ground up. She is smart, driven, and highly numerate. After selling a portion of her company, she finds herself with a significant amount of capital to invest. Believing that the skills that made her successful in business, hard work, deep research, and a contrarian mindset, will translate directly to the stock market, she decides to manage her own portfolio. She sees passive index fund investing as mediocre, a strategy for the unambitious. Sarah dives in headfirst. She subscribes to research services, reads dense financial reports, and builds complex valuation models in Excel. She spends 15 to 20 hours a week on her hobby. She finds a few undervalued small-cap companies and makes some impressive initial gains. The thrill is immense. She feels the same rush she did in the early days of her startup. She is beating the market, and it validates her intelligence and work ethic. She tells her friends about her winning picks, enjoying the status of being a savvy stock picker. This continues for a couple of years. She has some big winners, a few frustrating losers, and an overall sense that she's doing quite well. One day, her accountant asks for a detailed report on her portfolio's performance for tax purposes. For the first time, Sarah sits down to do a truly honest, all-in accounting. She calculates her portfolio's precise, time-weighted annual returns since she started. Then, she does something she'd never bothered to do before. She pulls up a chart of a simple Vanguard S&P 500 index fund and calculates its return over the exact same period. The result is a punch to the gut. After all her work, all her stress, all the weekends spent poring over financial statements, her net return was 1.5 percentage points lower per year than what she would have earned by simply buying the index fund and going to the beach. But the calculation didn't stop there. She then considered the opportunity cost. She thought about the 20 hours a week she had spent on her portfolio. That was over 1,000 hours a year. What could she have done with that time? She could have developed a new service offering for her agency. She could have mentored younger entrepreneurs. She could have spent that time with her family. She realized that even if she had managed to beat the index by a small margin, the return on her time would have been abysmal compared to what she could have generated by focusing on her own business, the area where she possessed a true, world-class competitive advantage. The humbling realization washed over her. Her active investing efforts were not a profitable enterprise. They were a massive, stressful, and incredibly time-consuming failure, disguised as a sophisticated hobby. Sarah's journey is a perfect illustration of two powerful psychological principles that affect high achievers: the Dunning-Kruger effect and opportunity cost neglect. The Dunning-Kruger effect is a cognitive bias whereby people with low to moderate ability in a domain dramatically overestimate their competence. In investing, a little bit of knowledge can be a very dangerous thing. After reading a few books and having a couple of successful picks, it's easy to feel like you've cracked the code. This initial peak of Mount Stupid, as it's often called, leads to the kind of overconfidence that drove Sarah to believe she could easily beat the market, a zero-sum game played by millions of the world's smartest, most well-informed professionals. Even more insidious, however, is opportunity cost neglect. This is our brain's systematic failure to properly value the things we are not doing. Sarah could clearly see the returns in her brokerage account. What she failed to see was the invisible, phantom return she was forfeiting by diverting her most valuable resource, her focused intelligence and time, away from her own area of expertise. For an entrepreneur like Sarah, an extra hour spent on business development or strategic planning could yield a return of hundreds or even thousands of % over time. An extra hour spent trying to eke out an extra 1% of alpha in the stock market is, for almost everyone, a fool's errand. The S&P 500 index fund doesn't just offer a solid financial return. It offers the gift of time and focus, allowing you to redeploy your energy to the areas of your life where you can create genuine, world-beating value. This realization is the foundation for our final mental model, the Buffett's Bar Blueprint. This is the ultimate decision-making framework for any and all investments you consider for the rest of your life. Step 1 is to permanently install the S&P 500 index fund as your default setting. It is not just an investment. It is the baseline, the financial equivalent of sea level. It represents the return you are entitled to, with virtually zero effort, zero expertise, and minimal cost. It is the market's offer, available to you 24/7. Step 2 is to understand that any active strategy, any deviation from this default, must be rigorously measured against this bar. This applies to everything: picking your own stocks, investing in a friend's startup, buying an investment property, or even evaluating your own business ventures. The question is no longer the simple, naive, "will this make money?" The question becomes, Do I have a high degree of certainty that this investment will, over the long term, significantly and consistently outperform the simple passive return I can get from the S&P 500, after accounting for all fees, taxes, risks, and, most critically, my own time and effort? By framing the decision this way, you raise the bar for action to an appropriately high level. You will find that 99% of the opportunities that come your way do not clear this bar. The speculative stock tip from your brother-in-law? It doesn't clear the bar. The complex investment product pitched by a financial advisor? It doesn't clear the bar. For most people, even the time-intensive work of being a landlord for a rental property may not clear the bar once all the hassles and hidden costs are factored in. The Buffett's bar model simplifies your financial life and protects your capital. If an opportunity isn't a resounding, obvious yes when measured against the effortless alternative of the index, the default answer is no. The antithesis to this disciplined framework is the hobbyist investor. This individual doesn't treat the market as a serious mechanism for wealth creation, but as a form of entertainment. They love the intellectual challenge of trying to outwit the crowd. They enjoy the thrill of the hunt, the chase for the next big thing. They get a social kick out of telling their friends about their latest winning stock. For the hobbyist, the process is the reward. The danger is that they rarely, if ever, perform the kind of rigorous, honest self-assessment that our entrepreneur Sarah did. They suffer from selective memory, vividly recalling their brilliant winners while conveniently forgetting their embarrassing losers. They don't track their performance against a benchmark because, on some level, they don't want to know the truth. The truth would spoil the fun. They are, in effect, using their retirement funds to pay for a very expensive form of entertainment. They are at the casino, but they've convinced themselves they are in the library. The Buffett's bar model is the enemy of the hobbyist investor because it replaces the thrill of the game with the cold, hard logic of a benchmark. It forces you to ask whether your hobby is actually contributing to your goal of financial freedom, or if it's just a costly and elaborate form of ego gratification. The direct financial connection of this principle is the formalization of the concept of alpha. In the world of institutional finance, alpha is the holy grail. It represents the excess return of a portfolio relative to its benchmark. If the S&P 500 returns 10% in a year, and your hand-picked portfolio of stocks returns 12%, you have generated 2% of positive alpha. If your portfolio returns 8%, you have generated 2% of negative alpha. The entire active management industry is built on the promise of delivering positive alpha. The Buffett's bar model compels you to become the ruthless alpha auditor of your own life. You must calculate your personal alpha. Take your total return over a given period and subtract the return of a low-cost S&P 500 ETF over that same period. The number you are left with is the true measure of your stock-picking skill. What the overwhelming majority of people will find, if they are honest, is that they have consistently generated negative alpha. They have spent time, energy, and money to achieve a result that is worse than doing nothing. The financial transformation that occurs when you grasp this is profound. You stop chasing the elusive ghost of alpha and instead dedicate yourself to efficiently and cheaply capturing beta, which is simply the return of the market itself. You realize that the path to massive wealth for the 99% is not about being smarter than everyone else. It is about having the humility and the discipline to hitch your wagon to the collective genius of the market and let the incredible power of compounding do the heavy lifting for you. This is the final and most powerful lesson from the Oracle of Omaha. True wealth management isn't about beating the market. It's about letting the market build your future. So after this deep exploration, what have you truly gained? You have acquired more than just knowledge about an investment product. You have acquired a powerful mental tool, a new operating system for making financial decisions. You have learned the Buffett's bar, the principle that the simple, low-cost S&P 500 index fund is not just an investment, but the fundamental benchmark against which all other uses of your time and capital must be ruthlessly measured. This single concept, when applied with discipline, can shield you from a world of costly mistakes, saving you from the tyranny of fees, the temptations of speculation, and the destructive impulses of your own psychology. It is the foundation of a rational and prosperous financial life. But here we must acknowledge a critical distinction. This entire framework is the answer to the question, what should 99% of people do with 99% of their money? It is the bedrock. It is the default. It is the intelligent path to financial freedom for the vast majority. However, it is not the full story of how Warren Buffett himself became one of the wealthiest people on earth. He built his empire not by buying the whole haystack, but by finding a few extraordinary needles and betting the farm on them. The principles we have discussed are his prescription for the public, but his personal practice involved a different, far more concentrated and demanding set of mental models. The strategy you have just mastered is about defense. It is about protecting yourself from the negative-sum game of the public markets. The next layer of understanding, the strategies that Buffett and other master capital allocators use for their truly consequential decisions, is about offense. It's an entirely different intellectual landscape. The video that is now appearing on your screen is designed to be the next piece of that map. It is the bridge from the wisdom for the 99% to the thinking of the 1%. It explores the principles that govern the other side of the coin. Your journey of financial education does not have to end here. You have built the foundation, which is the most critical step. Now you have a choice. If you are content with this simple, powerful, and profoundly effective path to building wealth, then your mission is complete. You have the key. But if you are one of the few who feels a pull to understand the entire system, if you have the intellectual curiosity to explore how the masters sometimes break their own rules, if you need to know how concentrated value-based betting can create generational fortunes, then the link that connects these two worlds is waiting for you. This isn't just about watching another video. It is about continuing your ascent. It is about completing your mental arsenal. The next piece of the puzzle is right there. Click and continue the journey.